The Federal Reserve is often described as the single most powerful economic institution in the country, and yet most Americans go entire years without giving it a single conscious thought, even as its decisions quietly determine what they pay for a mortgage, a car loan, or the interest on a credit card balance, and even as those decisions ripple through global financial markets within seconds of being announced. Picture a software engineer named Daniel living in Seattle with his wife Emma, a high school teacher, the two of them managing a mortgage, a set of retirement accounts, and a newborn daughter, going about their lives with the quiet, largely unexamined assumption that the economy always eventually finds its way back to normal, that inflation rises and falls, that interest rates shift up and down, that recessions come and recessions go, and that somewhere in the background, the Federal Reserve is steering the ship steadily enough that ordinary families never really need to think about who is actually at the wheel. That assumption gets tested the moment a shock arrives that the Fed's usual playbook was never really designed for. Imagine a sudden geopolitical crisis disrupts a critical global shipping route for oil. Energy prices spike as a result, and within weeks, that spike ripples outward into everything downstream of energy, from the price of gasoline at the pump to the cost of shipping groceries to the price businesses pay to heat and cool their buildings. This is not a hypothetical scenario invented for a story. It has effectively already been the defining economic backdrop of 2026, after a conflict involving Iran disrupted traffic through the Strait of Hormuz, a choke point that historically carries something close to 20% of the world's crude oil, sending Brent crude prices surging past $100 a barrel and pushing American gasoline prices, in some states above $5 a gallon. Economists at major banks and research institutions moved quickly to model the fallout. And the language that kept surfacing in their notes was the same uncomfortable word economists have used to describe the most difficult kind of economic environment for a central bank to manage: stagflation, the toxic combination of persistently high inflation, slowing economic growth, and rising unemployment occurring all at once, a combination that leaves the traditional tools of monetary policy fighting against themselves rather than working in the same direction. Daniel watches his household budget absorb the impact almost immediately, gas prices climbing every week, the grocery bill creeping upward, and a growing unease every time he checks the news to see how the conflict overseas is unfolding, since so much of what happens to American prices in this scenario ultimately depends on decisions being made thousands of miles away and completely outside anyone's domestic control. The Federal Reserve responds the way it typically responds to inflation, adjusting interest rates in an effort to cool demand and bring price growth back toward its long-standing 2% target. And this is not merely a hypothetical response either. Through the first half of 2026, the Fed actually held its benchmark rate steady across 4 consecutive meetings, keeping it in a range of 3.5% to 3.75%, even as inflation readings kept coming in stubbornly above target, with officials sharply raising their own internal inflation forecasts for the year from an earlier projection of around 2.5% up to 3.6%, largely because of exactly this kind of energy-driven supply shock, one that traditional interest rate tools are notoriously poor at addressing, because raising the cost of borrowing does very little to unclog a blocked shipping lane or lower the price of oil coming out of the ground on the other side of the world. Daniel notices something shifting in the tone of financial coverage during this period, language he had genuinely never encountered before. Phrases like the Fed losing control of inflation expectations, a concept that sounds abstract until you understand what it actually means in practice, that the real danger isn't simply today's higher prices. It's the possibility that businesses and workers start assuming prices will keep rising indefinitely and begin adjusting their own behavior accordingly, raising prices preemptively, demanding higher wages to keep pace, and effectively building an inflationary spiral out of nothing more than the shared belief that one is already underway. This is precisely the dynamic that made the late 1970s such a formative, cautionary chapter in the Fed's institutional memory. Under Chairman Arthur Burns, the Fed became widely blamed by economists for allowing runaway inflation to take hold by repeatedly succumbing to political pressure from the Nixon administration to keep interest rates low heading into the 1972 election, a decision many historians now view as a textbook example of what happens when a central bank's independence gets compromised by short-term political considerations, and the consequences of that capitulation played out for the better part of a decade. It ultimately fell to Paul Volcker, appointed Fed chair in 1979, to break that inflationary spiral through what remains one of the most consequential and most painful episodes in the history of American monetary policy, pushing the federal funds rate to a staggering 20% in 1981, a level that dragged the economy into a brutal recession and pushed unemployment to nearly 11%, the highest level since the Great Depression, triggering intense backlash from members of both political parties, with one congressman during a hearing at the time accusing the Fed of destroying Middle America, and another threatening to introduce legislation to impeach Volcker outright. Volcker refused to back down, insisting the recession was not something the Fed had caused, but rather the unavoidable cost of curing an inflation problem that had already metastasized throughout the economy. And by the mid-1980s, inflation had indeed fallen from a peak above 14% down into the low single digits, an outcome economists now widely credit not merely to the mechanical effect of higher rates on demand, but to something more psychological and harder to quantify: the re-anchoring of inflation expectations themselves, the moment when businesses, workers, and investors finally believed the Fed was serious enough about price stability that they stopped behaving as though runaway inflation was simply the new permanent normal. That episode established what has become the bedrock principle of modern central banking, that a central bank's long-term effectiveness depends heavily on its credibility, its demonstrated willingness to accept short-term economic pain in service of long-term price stability, and that once that credibility is genuinely earned, it actually lowers the cost of every future policy decision because markets and households trust the institution's commitments even before the results show up in the data. This is precisely why the question of Federal Reserve independence has resurfaced so prominently in recent political discourse, because that same historical lesson about Arthur Burns and Richard Nixon has repeatedly been invoked by economists and commentators worried about renewed political pressure on the central bank, including sustained public criticism from President Trump directed at the Fed's rate-setting decisions and, more recently, a change in Fed leadership itself, with Kevin Warsh confirmed as the new Fed chair in May of 2026, after being nominated in part because the administration hoped he would push more aggressively for lower interest rates. What actually happened once Warsh took the chair complicates that narrative considerably, because at his very first meeting running the Federal Open Market Committee in June of 2026, held against the backdrop of the Iran conflict's inflationary energy shock, the committee voted unanimously to hold rates steady rather than cut them, with Warsh explicitly telling reporters that the committee remained unambiguous and unanimous in its commitment to deliver price stability, and the Fed's own updated economic projections actually leaned more hawkish than before, with a majority of officials now signaling they expect to raise rates before the end of the year rather than lower them. A reminder that even under new leadership installed with an explicit mandate toward lower rates, the institution's internal culture and data-driven decision-making process pushed back hard against short-term political pressure, at least in this instance. Daniel and Emma feel the broader economic strain in ways that mirror what analysts were tracking across the country during this period. Job growth had been resilient for months, but cracks began appearing, with the national unemployment rate drifting up toward 4.5% as hiring slowed and some sectors reported outright job losses, while forecasters at major banks openly raised their odds of a broader downturn occurring within the next 12 months, with one prominent estimate putting the probability of a recession at roughly 30%, specifically because of the surge in oil prices. Financial markets, meanwhile, grew increasingly volatile as investors struggled to price in an unusually murky outlook, uncertain whether the Fed's next move would be a hike aimed at containing inflation or a cut aimed at supporting a weakening labor market, a genuinely uncomfortable dilemma because the two goals point in opposite directions, and every rate decision under those conditions risks making one problem better while making the other one worse. Economists at the European Central Bank explicitly warned that a prolonged diversion of this conflict could push major energy-dependent economies into outright stagflation, and modeling from several investment banks projected that if the disruption to oil shipping persisted through the summer, gasoline prices in the United States could climb well past $3.50 a gallon on average, with inflation becoming what one analysis bluntly called a permanent problem rather than a temporary spike. Daniel's employer, like many companies navigating this same uncertainty, quietly freezes promotions and slows hiring, not because the company is in obvious distress, but because nobody in a position to make long-term investment decisions wants to commit capital while the path of interest rates, energy costs, and consumer demand all remain this unclear simultaneously. Emma notices something similar playing out at the school district level. As local governments that rely on issuing municipal bonds to finance everything from new school buildings to basic infrastructure maintenance find themselves facing higher borrowing costs, since municipal borrowing costs tend to move in the same direction as the broader interest rate environment the Fed is managing, meaning even institutions with no direct connection to oil markets or Federal Reserve policy debates end up absorbing real financial consequences from a crisis playing out an ocean away. The retirement accounts fluctuate along with the broader stock market, which during periods like this tends to swing sharply from one trading session to the next, as investors continuously reprice their expectations for where rates, growth, and corporate earnings are all heading, a level of volatility that leaves Daniel checking his account balance more frequently than he ever used to, even though nothing about his actual long-term financial plan has fundamentally changed. Underneath all of this sits a deeper structural question that economists have been debating with unusual intensity throughout this period, whether the traditional relationship between unemployment and inflation, the trade-off central banks have relied on for decades when deciding how aggressively to raise or lower rates, still behaves the way it used to in a world where a geopolitically driven energy shock, rather than simple excess demand, is the primary source of rising prices. Raising interest rates works reasonably well at cooling an overheated economy where too much money is chasing too few goods. But it does comparatively little to unblock a strait that a foreign military conflict has closed to shipping, meaning the Fed genuinely does find itself, in this specific kind of scenario, holding a tool that is only partially suited to the problem directly in front of it, forced to weigh the risk of tightening policy into an already slowing economy against the risk of allowing inflation expectations to become unanchored the way they did in the late 1970s. International investors, watching all of this unfold, begin asking harder questions about the durability of American economic stability, with some reports during this period noting a broader unease, sometimes described as a sell America dynamic, in which international capital that once treated American assets as an automatic safe haven grows somewhat more hesitant, nudging the value of the dollar lower at points, and in turn, making imported goods modestly more expensive, adding one more small inflationary push on top of an already elevated baseline. None of this means the system is careening toward collapse, and it is worth being precise about the distinction economists themselves draw in moments exactly like this one. The Fed chair has said plainly, in one form or another, that today's conditions remain manageable and that markets continue functioning normally, even as the longer-term trajectory demands real vigilance, a formulation that sounds almost like a hedge until you sit with what it actually implies, that nothing about any single week of trading should alarm anyone, while the cumulative direction over months and years absolutely deserves close and sustained attention. Historically, this is also where the more hopeful half of the story tends to begin. Energy shocks, however painful in the moment, have tended to resolve as new supply comes online, as alternative shipping routes and energy sources absorb some of the disruption, and as the underlying conflict driving the crisis eventually eases, whether through diplomacy, military resolution, or simple exhaustion. When that happens, inflationary pressure gradually eases as well, giving the Fed more room to pursue the delicate balancing act it has been navigating throughout, calibrating policy carefully enough to bring prices back toward target without triggering the kind of severe, prolonged downturn that defined the early 1980s. Daniel, watching all of this unfold from his kitchen table in Seattle, comes away with a realization that feels less like relief and more like recalibrated understanding. The Federal Reserve was never actually built to eliminate every economic shock the country might face. No institution realistically could be, especially one confronting problems that originate not in domestic monetary conditions, but in a war being fought thousands of miles away over a shipping lane most Americans had never heard of before oil prices spiked. Its real strength, the thing that actually keeps a difficult moment from spiraling into a genuine crisis, lies in maintaining enough public and institutional credibility that people continue believing inflation will eventually come back under control, and that the broader financial system will keep functioning even when individual months look genuinely alarming. That credibility is not an abstract or sentimental idea. It is the very thing Paul Volcker spent an entire brutally unpopular tenure rebuilding after his predecessor let it erode, and it is the same thing every subsequent Fed chair, including the one now navigating an energy shock in a politically charged environment simultaneously, has had to consciously protect, because once that trust genuinely breaks, even a comparatively modest economic problem can metastasize into something considerably larger and harder to unwind. The deeper lesson embedded in this entire episode, one that applies regardless of how the current energy crisis specifically resolves, is that modern economies do not run purely on interest rates, money supply, and economic data. They run just as much on the shared, largely unspoken belief among households, businesses, and investors that the institutions managing the system remain competent and credible enough to be trusted through a difficult stretch. When that belief holds, even genuinely difficult shocks like an oil-driven inflation spike layered on top of a slowing labor market tend to get absorbed without spiraling into full-blown catastrophe. When that belief breaks down instead, the consequences can compound in ways that are considerably harder to reverse than any single interest rate decision could ever fix on its own. The real question, hanging over Daniel and Emma's kitchen table, and over households across the entire country navigating the same stretch of economic uncertainty, is not really whether the Federal Reserve will eventually face another serious test of this kind. Because history, from the 1970s all the way through the current energy shock unfolding in 2026, makes unmistakably clear that it certainly will again at some point down the road. The real question is whether the institution's tools, its accumulated credibility, and the public's underlying confidence in it will prove resilient enough to guide the economy through whatever the next unexpected shock turns out to be, especially in an era where geopolitical conflict, energy market fragility, and domestic political pressure on the Fed's independence all appear capable of arriving at exactly the same moment rather than one at a time. It is worth taking a closer look at exactly what tools the Fed actually has available in a moment like this, because the popular understanding that the central bank simply moves a single dial called interest rates up or down only captures part of a considerably more complicated toolkit. The federal funds rate, the overnight rate banks charge each other to borrow reserves, remains the primary and most visible lever, and its effects ripple outward within days into mortgage rates, auto loan rates, credit card interest, and the yields banks offer on savings accounts. But the Fed also manages the size and composition of its own balance sheet, a tool that became especially prominent after the 2008 financial crisis, and again during the 2020 pandemic, when the Fed purchased trillions of dollars in treasury bonds and mortgage-backed securities in an effort to push longer-term borrowing costs down, even after the short-term policy rate had already fallen close to zero. During the depths of the pandemic response, the effective federal funds rate fell to a record low near 0.04%, a level almost impossible to imagine just a few years later, as the committee found itself instead debating whether to raise rates further in response to an entirely different kind of shock. This history matters because it illustrates just how dramatically the appropriate policy response can shift depending on the nature of the crisis, since the tools that worked well to support a demand-starved economy during a pandemic lockdown are largely the opposite of what a central bank needs to deploy when confronting a supply-driven energy shock layered on top of already elevated inflation, which is precisely the bind the Fed found itself navigating throughout 2026. The committee's dual mandate, its legal obligation to pursue both maximum employment and stable prices simultaneously, becomes an especially uncomfortable balancing act during a stagflationary episode, precisely because the two goals typically move in opposite directions during ordinary economic cycles, meaning a policymaker can usually address one without seriously undermining the other. But during a genuine stagflation scare, higher unemployment and higher inflation arrive together, forcing officials to choose which threat to prioritize with tools that were never really designed to fight both fronts at once. Fed officials have been candid about this tension in their public communications throughout the year, acknowledging that inflation stemming specifically from an external energy supply shock behaves differently than inflation driven by an overheating domestic economy, and that raising rates aggressively in response to a supply shock risks compounding the very slowdown in growth and hiring that a stagflationary environment already produces on its own without necessarily doing much to bring energy prices themselves back down, since those prices are being set largely by geopolitical events entirely outside the Fed's jurisdiction. This is part of why the committee's June 2026 decision to hold rates steady, while simultaneously signaling openness to a future hike, reflected such a genuinely difficult and almost contradictory posture, essentially communicating that officials were unwilling to loosen policy prematurely while an energy shock remained unresolved, but equally unwilling to tighten aggressively into a labor market that was already showing signs of softening, opting instead to wait for more clarity on whether the energy shock would prove temporary or would instead work its way more permanently into broader price expectations across the economy. Historical comparisons to the 1970s inevitably surface in these conversations, though economists are generally careful to note the comparison is imperfect in important ways. The original stagflationary episode of that decade unfolded over the better part of 10 years, compounded by two separate oil shocks, a fundamentally different monetary policy framework that lacked any explicit inflation target at all, and a Fed whose independence had already been meaningfully compromised, well before Volcker arrived to fix it. The current episode, by contrast, is unfolding against the backdrop of an institution operating with a well-established 2% inflation target, a much longer track record of central bank independence as an accepted norm, and considerably more sophisticated tools for communicating policy intentions to markets in real time, all of which give the modern Fed meaningfully more credibility to draw upon than Arthur Burns ever possessed. Whether that accumulated credibility proves sufficient to keep inflation expectations anchored throughout a prolonged energy shock, without requiring anything close to the brutal, decade-defining response Volcker was ultimately forced to deliver, remains the open question sitting at the center of this entire story, one that will not be definitively answered by any single month of economic data, but rather by the accumulated pattern of decisions, credibility, and public trust built up over the months and years still to come. There is also a slower, more structural dimension to this story that rarely makes it into the daily headlines about a single rate decision, and it has to do with how episodes like this one shape the way the rest of the world thinks about the dollar and about American economic management more broadly. The dollar's status as the world's dominant reserve currency has always rested on a kind of quiet, continuously renewed confidence. The belief among central banks, corporations, and investors around the globe that American monetary policy will remain competent, predictable, and reasonably insulated from short-term political interference. And each time that confidence gets tested by a stretch of high inflation, unusual market volatility, or visible political pressure on the Fed's independence, it adds one more data point to a broader conversation international investors have been having for years about whether they should keep concentrating quite so much of their reserves in dollar-denominated assets. The conversation predates the current energy shock by a considerable margin. But episodes like this one, where inflation runs stubbornly above target, unemployment drifts upward, and a new Fed chair's independence gets publicly tested within his very first weeks in office, tend to sharpen exactly the kind of questions that drive gradual shifts in global reserve allocation over time, even when no single episode is dramatic enough on its own to trigger any kind of sudden wholesale abandonment of the dollar. For Daniel and Emma, none of this abstract global reserve currency discussion registers directly in their daily lives, but its downstream effects eventually do, because a dollar that commands less automatic global confidence tends to buy less when American consumers purchase imported goods, adding one more incremental source of inflationary pressure layered on top of whatever domestic and energy-driven forces are already pushing prices upward. What ties all of these threads together, from the mechanics of the federal funds rate, to the psychology of inflation expectations, to the slow-moving question of dollar dominance on the world stage, is the same underlying insight that keeps resurfacing throughout this entire story in different forms. Confidence is not a soft, secondary consideration layered on top of the real economic mechanics. It is arguably the primary mechanism through which all of the more technical machinery actually functions, since interest rate decisions only work as intended if households and businesses actually believe the central bank will follow through on its stated commitments. And since a currency only retains its reserve status as long as enough of the world continues believing, it will remain a stable, reliable place to park capital. Daniel finds himself, somewhat to his own surprise, paying closer attention to Fed announcements than he ever used to, not because he suddenly understands every technical detail of monetary policy, but because he has come to appreciate, in a way he never fully had before this particular stretch of economic turbulence, just how much of his own family's financial security ultimately depends on an institution most people never think about until the exact moment its performance genuinely matters.